A new report has entered the war room. The Clarity Act has advanced, but it is not yet law. H.R. 3633, the Digital Asset Market Clarity Act of 2025, passed the House and moved into the Senate process. The Senate Banking Committee later advanced the bill out of committee, placing the next gate before the full Senate. But advancement is not enactment. This briefing is not a prediction. It is not a recommendation. It is a disciplined review of where the bill stands, what it attempts to clarify, what potential benefits supporters see, what risks critics raise, and what investors should continue to verify before drawing conclusions. In the market, uncertainty can become a weapon against the unprepared. So before the headlines move the crowd, we enter the record. Preparation before prediction. Section 2. What the bill tries to clarify. At the center of the Clarity Act is a basic question with major consequences. Who regulates what? In the current digital asset battlefield, the same token can be described by different people in different ways. One side may speak in the language of securities, another side may speak in the language of commodities. A platform may call itself an exchange, a broker, a dealer, a marketplace, or something else entirely. The bill tries to draw clearer lines. As written, H.R. 3633 seeks to build a regulatory structure around digital commodities, while also addressing the roles of the Securities and Exchange Commission and the Commodity Futures Trading Commission. That does not mean every question disappears. It means the bill attempts to define the field of battle. Which assets fall under which category? Which intermediaries must register? Which disclosures may be required? And which agency may have primary authority over different parts of the market? For investors, this matters because regulation is not just a legal issue. It can affect listings, liquidity, platform obligations, disclosure standards, enforcement risk, and the confidence of institutions deciding whether to enter or stay on the field. So the first thing to understand is simple. The Clarity Act is not only about crypto prices. It is about market structure, and market structure shapes the battlefield before capital ever moves. Section 3. The potential pros. Supporters of the Clarity Act see the bill as an attempt to bring structure to a market that is often operated through uncertainty, enforcement actions, court interpretations, and competing agency views. The first potential benefit is clearer jurisdiction. If Congress defines when a digital asset falls into one regulatory lane instead of another, companies, platforms, issuers, and investors may have a more consistent rulebook to study. The second potential benefit is a clearer path for market intermediaries. Exchanges, brokers, dealers, and other digital asset platforms would have to understand registration, compliance obligations, disclosure expectations, and the standards that apply to their activities. The third potential benefit is improved market credibility. Large institutions often require defined rules, custody expectations, reporting obligations, supervisory standards, and legal clarity before they commit serious capital to a market. But a potential benefit is not a guarantee. Clearer rules do not make a weak token strong. They do not remove volatility. They do not eliminate speculation, fraud, poor risk management, or emotional decision-making. Clarity is a map. It is not protection by itself. For the market warrior, the question is not, will this bill make prices go up? The disciplined question is, could this bill create better conditions for research, accountability, disclosure, and market structure? That is the real pro case. Not hype, not certainty, not a promise of gains. The possibility that a defined battlefield may be easier to study than one hidden in fog. Section 4. The potential risks. A clearer battlefield is not automatically a safer battlefield. That is the central warning from critics of the bill. Supporters of the Clarity Act argue that the bill creates a stronger framework for digital assets, assigns regulatory responsibility, protects investors, and reduces the confusion that bad actors can exploit. But critics see a different danger. They argue that the bill may narrow the reach of securities regulation, move too much activity toward a commodity-style framework, and create openings that sophisticated firms could use to avoid stronger investor protection rules. For investors, the concern is not only what the bill says. It is how the definitions are written, how the agencies divide authority, how quickly rules can be implemented, and whether enforcement remains strong after the law changes. A token can still be weak, a platform can still fail, a market can still become speculative, fraud can still exist inside a regulated environment, and even a legal framework can be misunderstood by the crowd as a signal that everything inside the market is safe. That is a dangerous assumption. Regulatory clarity may reduce one kind of uncertainty, but it does not remove business risk, technology risk, custody risk, liquidity risk, leverage risk, or human behavior. For the market warrior, the lesson is simple. Do not confuse a rulebook with protection. Do not confuse legislation with approval. And do not confuse market structure with margin of safety. The risk is not that clarity has no value. The risk is that clarity may be mistaken for certainty. And in the markets, certainty is often where discipline begins to fail. Section 5. What still must happen? The Clarity Act has advanced, but advancement is not enactment. That distinction matters. The House has passed H.R. 3633. The bill then moved into the Senate process. The Senate Banking Committee later advanced the legislation, sending it toward the Senate floor. But the full Senate still matters. The text still matters. The final version still matters. Before the bill can become law, the legislative process must continue. The Senate must act. If the Senate changes the bill, the final text must be reconciled with the version passed by the House. Only after Congress completes its work can the measure move to the President. For investors, this is where discipline is required. Do not trade the headline as if the outcome is already complete. Do not assume that committee advancement means final passage. Do not assume that the final version will match the version being discussed today. Bills can change. Definitions can change. Effective dates can change. Agency authority can change. Compliance obligations can change. And market expectations can move faster than the actual lawmaking process. That is why the disciplined approach is to watch the gates. First, the full Senate. Second, any changes to the text. Third, any reconciliation with the House version. Fourth, final congressional approval. Fifth, presidential action. Until those gates are crossed, the Clarity Act remains an advancing proposal, not a finished law. Preparation before prediction means respecting the process before reacting to the crowd. Section 6. What investors should watch. At this stage, the disciplined investor should not watch only the headlines. The disciplined investor should watch the text. Headlines can compress a complex bill into one sentence. Markets can react before the details are understood, and social media can turn a procedural step into a prediction. That is not preparation. Preparation means watching the parts of the bill that can actually shape the battlefield. First, watch the definitions. How the final text defines a digital commodity, a digital asset security, an intermediary, an exchange, a broker, a dealer, a custodian, or a platform can determine which rules apply. Second, watch agency authority. The division of responsibility between the Securities and Exchange Commission and the Commodity Futures Trading Commission matters. It can affect registration, disclosure, supervision, enforcement, and the obligations placed on market participants. Third, watch amendments. A bill that moves through Congress can change before it becomes final. One amendment can alter definitions, timelines, exemptions, agency power, or compliance obligations. Fourth, watch effective dates. Even if a bill becomes law, the rules may not take effect immediately. Agencies may need to write regulations, create forms, open registration pathways, and issue guidance. Fifth, watch market behavior. Do not assume that legal clarity automatically creates rational markets. Speculation can still outrun substance. Liquidity can still vanish. Weak projects can still fail. Strong headlines can still hide weak fundamentals. The market warrior does not chase noise. The market warrior studies the record. Watch the text. Watch the authority. Watch the timeline. Then decide what the evidence actually says. Section 7. The research path. A war room briefing does not replace your research. It gives you a starting point. The Clarity Act has advanced, but the disciplined viewer should continue to verify the record. Start with the bill itself. Read the official text. Watch the definitions. Study the sections that describe digital commodities, digital asset securities, intermediaries, registration, exemptions, agency authority, and effective dates. Then verify the status. Also, watch the yield issue. One disputed question is whether digital asset platforms, brokers, exchanges, or stablecoin-related intermediaries should be allowed to offer yield, rewards, or similar payments on customer balances. Banks and financial institutions have argued that yield-bearing digital dollar products could pull deposits away from the banking system and affect the funding base used for lending. Crypto market advocates may see the same issue differently, as a question of competition, consumer choice, innovation, and whether non-bank platforms should be allowed to offer financial incentives inside a regulated framework. That is why the final text matters. Use official congressional sources. Confirm whether the bill has only passed the House, whether the Senate has acted, whether the text has changed, whether amendments have been added, and whether final congressional action has occurred. Then compare analysis. Read supporters, read critics, read official summaries, read legal commentary, read market commentary. But do not let any single voice replace your judgment. The purpose of this briefing is not to tell you what to think. It is to show you what to examine. For the digital asset industry, the Clarity Act may become an important battlefield. It may shape how platforms register, how assets are classified, how agencies divide authority, and how institutions assess regulatory risk. But the lawmaking process is still the process. The market is still the market. Risk is still risk. A headline is not a conclusion. A bill is not a guarantee. And clarity is not certainty. The market warrior does not outsource judgment to the crowd. The market warrior studies the record, compares the evidence, protects capital, and prepares before reacting. This has been a Sun Tzu Trading War Room briefing. Preparation before prediction.